QuickBooks Online 2025 Inventory Quantity Adjustment Form. Get ready and some coffee because we're learning to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody looking for a result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to be selecting the United States version of the software and verifying that we are not a robot if needed. I'm going to close that first tab because it's no longer needed. We'll then be in the sample company file, Craig's Design and Landscaping Services. Let's go to the reports on the left-hand side as we do every time. We're in the Standards tab, Favorites. We're going to be right-clicking on that balance sheet to open it in a new tab. Same with the profit and loss. Right-click, open it in a new tab. Tapping to that middle tab, closing up the hamburger. We want to make that range a 2-year time frame. 01/01/24 tab, 12/31/25 tab. Look at it by years, run it to refresh it, 24/25 now side by side. Let's go to the next side to the right on the tabs, closing up the hamburger, and then we'll change the range once again to the same. 01/01/24 tab, 12/31/25 tab, dropping it down so we can see it in years, running to refresh it, noting there's nothing currently in 2025 on the profit and loss or income statement except for that $53.99 for some reason. Nothing there because we have refreshed the system and opened in incognito window. Therefore, even prior presentation transactions have been removed and refreshed, which I recommend you do as well. So we have as close to the same data as possible as we go forward. Let's go to the first tab. We're going to select the drop down. We've been looking at the forms for the data input, mainly by cycle. The customer revenue cycle, the vendor or expenses cycle, the payroll cycle, and then we've been over here in the misfits, the forms that don't fit in any particular cycle. They're just not in any group, man. They're doing their own thing over here, but they're still important, and that's why we have them in this drop-down window. And now we want to look at the inventory quantity adjustment form. So first, quick recap on inventory, because once you level up or once you have inventory within a business, you have to ask the question of how you're going to be dealing with inventory, how you're going to be tracking that inventory, and that will also tell you how you're going to be entering that inventory into the system. For that, let's take a quick recap of our flowchart. This is a desktop homepage flowchart. I know we're using QuickBooks Online, but we're just looking at the flow of the forms, and this is a beautiful, nice flow of the forms for any type of accounting software or system, which basically will have similar flows. So if we have inventory, we're gonna have to purchase inventory, which is gonna happen on the purchasing side. So you can think of it as going through the vendor cycle or purchases or expense cycle. And it's also gonna have a revenue side of things because we're going to move it from inventory, the asset, to the expensive cost of goods sold when we sell it, that being an accrual process, typically with the use of the form of the invoice form and the sales receipt. Now, in order to do that on what we call a perpetual inventory system, it's somewhat complex to set up within QuickBooks because we have to set up not only the inventory account tracking by dollar, but also by inventory items and units of inventory items. So for example, when you scan something at a grocery store, we see the dollar amount that it's going to cost, but the system is also recording on a perpetual inventory system the reduction in the inventory in dollars as well as in units and the related cost of goods sold. So that would mean that we would have to set up the inventory items within the QuickBooks system. And when we purchase the inventory items with a bill form or a check form, it would increase not only the dollar amount of the asset account of inventory, but also the units of inventory by item. And then when we sell the inventory with an invoice or sales receipt, those are the forms that we would typically have to use because they would give us the items, allowing us to then reduce the inventory at the point of sale, not only in dollar amount, but also in terms of units on the subledger. Now, you might come up with a system and say, well, I don't want to do that within QuickBooks. It's too tedious, or possibly QuickBooks doesn't have the level of tracking inventory needed, and possibly you're going to be using an outside software. So for example, if you have a Shopify store or you sell stuff on Amazon or something like that, you might be tracking the units in that other software or possibly in Excel or something like that, and only periodically adjusting the dollar amounts in QuickBooks with basically adjusting entries possibly at the end of the year, at least for taxes, or on a quarterly basis, monthly basis, or weekly basis. You can imagine if you're at a food truck or something like that, or you sell items from a truck or something like that, that you would count, you'd actually physically count the items, right? And then you can determine how many you sold by doing the good old cost of goods sold calculation. You've got your beginning inventory plus your purchases. That's the goods that you have available for sale minus the ending inventory. The amount that you count at the end of the day gives you the amount that basically you sold, and you might periodically put that into the QuickBooks system, thereby not tracking the units of inventory, but periodically recording the cost of inventory in the QuickBooks system. So we're imagining here, for the purposes of our inventory adjustment form, that we're using a full perpetual inventory system. We're tracking the units of inventory within the system. That's usually the best internal control that you can have, because now the system is tracking the inventory as you buy it and sell it. And you might say, well, if the inventory is being tracked, I don't need to do a physical count anymore. But you still, of course, need to do a physical count, because you have to tie out your system to reality. That's what the internal control will be. And if you live like anywhere, like located where I live, for example, you have at least a few scumbags out there that would be willing to, rob their own grandma for a half-eaten sandwich as she's crossing the street and not have a second thought about it, right? So you got to deal with shrinkage. There's going to be possibly theft within the system. In California, they just let you steal the stuff, right? So there's going to be shrinkage, almost for sure. So you're going to have to do a physical count of the inventory so you can determine how much stuff the crazy jerks stole out there, and then you're going to have to write down the inventory periodically. So a full internal control inventory system is going to record the inventory increases when we purchase them with a bill form or a check form. It's going to record the decrease of inventory in dollar and units when we sell them, typically with the sales receipt form and the invoice form. And that will track the inventory. But then we're also going to do a physical count at the end of the night, the end of the week, the end of the month, the end of the year, to determine how much stuff the crazy people stole or how much spoiled or whatever else happened. And then usually the physical count is going to be the same or possibly less. Oddly, it could be more if there was an error that happened. And then we're going to have to write down the inventory to the physical count that's actually there. We can't say, well, the system's right and my physical eyeballs are wrong. I counted wrong. No, the physical eyeballs are wrong. If the system says there's 20 units and you counted 15 units, something happened. Something got spoiled. Someone stole something. There was an error in the data input. You've got to deal with reality and deal with the new inventory system, the actual physical count. All right, so that means that we're going to have to basically use this form in order to mark down the inventory. All right, so let's take a quick look at that. If I go to the first tab here, you'll note that here's our inventory account. If I go into it, let's go into the 2024 activity within it. You can see that this is being recorded in dollars, of course, and it's going to be increased. Notice it increased with an inventory quantity form to start with, but then we purchased inventory with checks, and we decreased the inventory when we sold them. That would be with invoice forms and sales receipt forms. So this is being tracked by dollar amount on the financial statements. Let's go back. The other side of that, when we sell it, is going to the income statement, and it's being recorded as cost of goods sold perpetually when we sell the items. And let's open up another tab to look at the subledger. So I'm going to duplicate. I'm going to right click and duplicate. And then we're going to go to the reports on the left-hand side, reports. And I'm going to look at the inventory valuation summary. Inventory valuation summary. Now we can also look at the inventory detail or the inventory worksheet. The inventory worksheet in particular might be designed specifically for a physical count. But let's first look at the inventory valuation summary. Going to close this up. And so there we have it. So now notice we still have the dollar amount here, but it's actually tracking the quantity of inventory units. Now again, you've got scumbags out there that'll steal your stuff. They'll steal it if you leave it on the porch for like 5 seconds. It'll be gone. And so you're gonna have to count the inventory, or else you won't know how much stuff was stolen, right? Especially in California, they actually incentivize that. The pirates are running the actual place, for crying out loud. In any case, so what you do is, so you have to count the inventory, and then if the physical count is less than that, you're gonna have to mark it down. You're gonna have to write it off. You're gonna have to record a transaction, reducing the units of inventory, which also reduces the dollar amount of the inventory, and records it to some kind of expense account, which might be cost of goods sold, or you possibly have an account for shrinkage or spoilage or theft, whatever you want to call it. All right, we can also, if I right click on this again and duplicate it again, and we're gonna go into the reports on the left-hand side. If I type in inventory again, inventory, we've got the inventory, physical inventory worksheet. So this will give us just the units of inventory. So now we've got the inventory on hand, just the units of inventory, and we can use this for the comparison. Now in an internal control, if you're at a larger type of company, what you really want to do typically is basically have someone count the inventory without the physical count worksheet. Otherwise, you might have lazy people out there. You might have union workers. We have a lot, that don't, if they can cut the corner, they're going to cut the corner, right? So you ask them to count the inventory, but if they already know that there's 25 units in the box, they might not count the box. It'll just tell you there's 25 units in it, right? So you want to not give them the answer and then have them count the inventory so that you can tie it out to the 20, to the 25, or the, right? So that's, so you can, and then we can basically get our physical count information. Then if it's something less, we can do our inventory adjustment. So let's go to this first tab and hit the plus button. And we're going to go into the inventory quantity adjustment. Inventory quantity adjustment. Let's make it on the 19th. Okay. And so the inventory adjustment account. So where do you want it to go? So the default is shrinkage here. Notice it's still a cost of goods sold type of account, meaning if I say, hey, look, I thought I had 10 units, but some scumbag stole 3 of them, then I'm going to have to write it down, right? So that means that I'm going to have to reduce the dollar amount of inventory, and the other side's going to have to go somewhere. When we sell the inventory, the expense account of selling it is cost of goods sold. But we might want to make another kind of account. We might call it shrinkage, which is the general account, which could include spoiling or theft, or we might just call it theft or spoils or whatever we want to call it. So we'll keep it the shrinkage. I think it's useful to have something other than cost of goods sold, because you would like to see the amount of expenses that you are incurring, not for the inventory sold, but for the inventory that was stolen or spoiled, right? So it's good to have it in a separate account. So then we're going to say that the product, let's say that on this one we had the fountain pump. So let's put in fountain pump right there, boom. And so the quantity on hand is 2. So wait a sec. This is a design fountain pump. Let's see, let me do this again. Hold on, there's a bug on my keyboard. All right, I got it. All right, let's try this again. This is gonna be, let's do this one. Design fountain pump, design fountain pump. This one has 25. Okay, let's say that we counted this one, and now, so this is the quantity on hand, but we say we counted it and there's only 21 of them. So that means there's a change of 4 that has been removed. So then we have down here, we can enter a memo if we want to, we can cancel it, we can clear it, we can save it. And in the drop down, we have save and new and save and close. What's this going to do when we record it? Well, it's going to adjust the physical count. So now it's going to take it down from 25 to 21, which is also going to have an impact then on the financial statements, which is recorded in dollar amounts. So we're going to take not the sales price, but the cost of the pumps, because that's what they're on the books for, times the 4 pumps. and that's the amount that's going to be reducing inventory for the adjustment. And then the other side is going to go to the expense, not cost of goods sold itself, because that's for a selling, but a cost of goods sold type of account of shrinkage representing the spoilage or theft. So let's save it and close it and check it out. Let's go to the balance sheet and we'll run it to refresh it. And we'll go into that inventory. Let's go into the inventory here. And we'll say, okay, quantity adjustment. So did it record it? I don't think it recorded. No, maybe that is it. Let's go into it. Let's go into that one, that 40. There it is. Yeah, so the 4 reduction. So boom, there it is on that side. Reduced it in a dollar amount of 40. It was 4 units. Apparently they cost $10 each. That's not the sales price. That's the cost. Let's go back. And then the other side's go into the income statement, because the other side's got to go somewhere. We got to expense it. It's gone. It's part of the expense of operations. It's a cost of operations, but it's not in cost of goods sold, because that's going to be the account for when we actually sell the unit. There it is. So I had to refresh the screen again. So it went into inventory shrinkage. So it's still putting it in the cost of goods sold type of a category, but we put it into a different account for shrinkage so we can see the cost of the inventory that has been consumed because we sold it versus the cost of inventory that has been consumed because it was stolen or it's spoiled. Notice that those two things are still expenses, of course. That's the expense of operations. That's the risk we take for doing business in California, right? You're going to deal with shrinkage. And so the question is, you know, can you put that into your business model and still make money with it? A lot of people can't. That's why they're leaving. But that's going to be the idea. So that should be an expense, lowering the net income. If we go to the tab to the right and run it again, we're going to say, all right, now the units for the pumps are down to 21 units where they were at the 25. If we pick up the dollar amounts, then we can see that they're $10 each on average. And so we have the total of $556.25, which should still tie out to what's on the balance sheet under the inventory. $556.25, is that what's over here? And we're at $556.25. So there it is. Everything should be tying out. So again, the general rule is with the shrinkage, you got to determine somehow that you're going to deal with shrinkage. Notice that if you have a periodic inventory system, it's hard to deal with shrinkage because the cost of goods sold calculation is going to assume that you sold the units of inventory. So you have to kind of tie out your sales, your actual sales, to the calculation of your cost of goods sold to try to calculate how much of it might have been shrinkage. In a full service system, you have a better ability to at least track how much has been stolen. So you might not be able to stop them in California, but at least you can see how much money you're losing, which might help you to make some decisions on that front. So, and that means that you're going to track the inventory perpetually within the system, but still do a physical count so that you can compare what's in your system compared to what's actually physically on ground, and then make those periodic adjustments so that, again, you can at least know what is happening, even if you can't stop what is happening, at least not in the short term.